We start off with Europe, where Eurostat has reported that Eurozone inflation surged unexpectedly last month and may rise further in the coming months if the conflict in the Middle East keeps energy prices high, possibly putting pressure on the European Central Bank to revisit its policy stance. Inflation in the 21 countries that share the euro jumped to a 1.9% from 1.7% a month earlier, outpacing expectations for 1.7%, as rising unprocessed food and services costs offset low energy prices. Underlying inflation, a closely watched measure which excludes volatile fuel and food prices, increased to 2.4% from 2.2% as services inflation, a top concern for policymakers, once again accelerated more than predicted. Meanwhile, European Central Bank policymaker Martin Kazaks said the ECB should sit tight and keep interest rates steady for now, as the US-Israeli attacks on Iran remains uncertain. He noted that the conflict may boost inflation but could also depress activity, meaning the Eurozone Central Bank should wait for the fog of war to clear before acting. Kazaks added that the ECB may come up with some scenarios about how the war could affect the economy at its next trade meeting on March 18-19. Statistics Austria reported that Austria's inflation edged higher in February 2026, with the harmonized index of consumer prices rising to 2.3% year-on-year, up from 2.0% in January and slightly above the European Central Bank's 2% Eurozone target. Inflation measured by the Consumer Price Index (CPI) also increased, reaching 2.2% year-on-year. Energy prices had a significant dampening effect, falling 4.1% comparing with February 2026 due to lower wholesale oil and electricity costs, a reduced energy tax, and a lower renewable energy subsidy. Services remained the main inflation driver, rising 4.0% year-on-year. In the UK, British Finance Minister Rachel Reeves stated that fresh forecasts showing inflation and borrowing would be lower than previously thought by the Office for Budget Responsibility, as she set out a budget update. The Office for Budget Responsibility expects British consumer inflation to average 2.3% in 2026, with 2.0% forecast for 2027 and 2028 unchanged from November projections. Moreover, Reeves noted that the government has a bigger margin for error for meeting its main fiscal target at the end of the decade. She noted that expected tax revenues were due to stand at £23.6 billion, above projected day-to-day spending in the 2029-30 fiscal year.
With £650 million committed in January to upgrade our Typhoon fighter jets, a new Royal Navy frigate launched from Rosyth last week, and just yesterday.
On trade relations, U.S. President Donald Trump has threatened to cut out all trade with Spain after the country blocked U.S. military access to its bases for operations linked to strikes on Iran. He criticized Spain for failing to meet NATO spending targets and called both Spain and the UK uncooperative on defense and territorial issues. Trump also voiced frustration over the UK's handling of the Chagos archipelago lease, describing it as shocking and highlighting the logistical difficulties it caused. He also noted that the U.S. could impose trade restrictions or embargoes on Spain if needed. In Asia, Bank of Japan Governor Kazuo Ueda has stated that the bank will continue raising interest rates if economic and price forecasts hold, while monitoring risks from Middle East tensions. Ueda noted that higher crude oil prices could hurt Japan's economy by worsening trade terms, potentially weighing on underlying inflation. However, sustained oil price increases could also push up inflation by raising medium and long-term expectations among households and businesses. Ueda emphasized that significant wage growth is needed for Japan to achieve its 2% inflation target sustainably, noting that real wages are largely determined by long-term productivity. That's all for today's economic news roundup. Thank you for joining us. Stay informed, stay ahead. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at Qnews. Stay tuned for more on these fast-moving economic